Collegiate Office Supply sells various office furniture items and uses a perpetual inventory system. At the beginning of October, it had no office chairs in stock. The following events occurred during October and November. October 6th, purchased 100 office chairs from Katz Ltd. for $68 each, terms N30, FOB shipping point. So what is happening in this transaction? Well, you're purchasing 100 office chairs, and in this situation, when you're buying anything that you want to resell, it's going to be debited into merchandise inventory. And when it says terms N30, that means you're not going to pay it right away. So that means there'll be a credit account to accounts payable. So N30, in this case, it means you have to pay the total amount in maximum 30 days. So you wouldn't be paying any cash right now on October 6th, but you would have to pay it maximum in 30 days. And in this case, accounts payable, we can write Katz Ltd. And it says for $68 each. So we want to know the value of the merchandise inventory that we bought, which in this case is the office chairs. So if you purchased 100 office chairs and each office chair costs $68, then the total amount of money that it cost for those 100 office chairs would be 100 times 68, which is 6,800. Notice that it says FOB shipping point. That is just some information about the shipping. So whenever it says FOB shipping point, that means the buyer will pay the shipping cost. And whenever it says FOB destination, that means the seller will pay the shipping cost. So we don't need to do anything about it right now. Now, on October 7th, it says paid $200 cash to freight company for the delivery of the chairs. So freight company, well, that's related to the shipping. And since we are the ones who bought the chairs and it's FOB shipping point, that means the buyer is going to pay. And in this case, we are the buyer. So that's why we're going to pay. And whenever the buyer pays for the shipping, the debit, it doesn't go to like any freight expense or something like that. It just goes into merchandise inventory. And since we paid cash, the credit account is going to be cash. And we paid $200. Now on October 9th, sold 30 chairs to Butler Inc. for $135 each on credit, terms N30, FOB destination. Hint, note that the freight charges from October 7th transaction will increase the cost per chair. So whenever you're selling merchandise, there's going to be two transactions, but two journal entries that you have to do each time you sell merchandise. So let's start with the accounts first. If you sold 30 chairs to Butler Inc., the debit account is going to be accounts receivable, since N30 means they're not going to pay you right away. They will pay you in maximum 30 days. And then the credit account, well, in a service business, you would expect it to be revenue, but whenever you're doing a merchandising company, it's going to be sales, which is kind of similar to revenue, but it's just the way we do it in merchandising. So sold 30 chairs for $135 each. So how much will the total money how much does Butler owe you? So that's going to be 30 times $135, and that's $4,050. Now, the second transaction is going to be just crediting the merchandise inventory account. Because when you're selling a chair, the chair is part of the merchandise inventory account. But when you sell it, that account is getting lower because you're losing the inventory, which is the chair. So we know that the credit account is going to be merchandise inventory, but we have to have a debit account as well. And in this case, we're just going to debit it to an account that is called cost of goods sold. And of course, the credit account is merchandise inventory. Now, this number is going to be the value of the merchandise inventory. So you sold it for $135 each, but when you bought it from CATS Ltd on October 6th, you bought it for $68 each. So that's the number that we want to put. And it says, hint, note that the freight charges from the October 7th transaction will increase the cost per chair. So notice how on October 7th, we debited the merchandise inventory. So whenever we pay for freight and we are the buyer, it increases the value of the merchandise inventory. So if we go back to October 6th, 100 chairs cost $68 each, and that's the total amount of merchandise inventory we have is $6,800. And then if you go to October 7th, it says you paid $200 for the delivery of the chair. So actually what happens is you're going to add 200. Well, yeah, you're going to add 200, which turns out to be 7,000. So 7,000 is the actual amount of merchandise that's the value of the total merchandise inventory that you have. Instead of $6,800, it's $7,000 for 100 chairs. Now, on October 9th, you sold 30 chairs. So we want to know the value of 30 chairs. So to do that, we have to find the value of one chair first. So we know that the value of 100 chairs is $7,000. So if you divide that by 100, we get 70. So $70 for one chair. And since you have 30 chairs, it's 70 times 30, which is 2,100. So that's the amount of merchandise inventory that we're going to lose. And this says FOB destination. So that means the seller is going to pay. And in this case, we sold it to Butler Inc. So again, we have to pay. And in October 10th, it says paid $30 cash to Freight Company for the delivery of the chairs to Butler Inc. So we're not going to debit merchandise inventory because this time we're the seller. So whenever we're the seller and we have to pay for freight, it goes into sort of an expense account, but it's called freight out. And the credit account is going to be cash. And how much did we pay? It's $30. Okay, on October 11th, gave Butler Inc. credit for 5 returned chairs. The chairs were returned to inventory. Okay, so in this case, we're also going to have 2 journal entries. First is going to be the credit part. So whenever you give credit for merchandise inventory that the person you sold it to returned, it goes into an account called sales returns and allowances. This account is debited, and the credit account is accounts receivable. And this is because when you give them an allowance, that means they don't have to pay you the full amount. They're going to pay you less. And since they haven't paid you yet, the amount that they owe you is going to decrease, which is why we're crediting accounts receivable. So we need to find out how much they paid for one chair. And if you go back to October 9th, we can see that $135 is a price for one chair. And we're going to give them credit for 5 chairs. So that's 135 times 5, which is 675. And that is the amount that they don't have to pay you because you're giving them credit. And the second part is the chairs were returned to inventory. So the chairs are basically merchandise inventory, and instead of giving it out, you're getting it back. So merchandise inventory is going to be debited. And the credit account is going to go into cost of goods sold. So notice how this is the complete opposite of when you're selling it. Like on October 9th, you debit cost of goods sold and you credit merchandise inventory. But on October 11th, when you're getting the chairs back, you are doing the opposite because you're getting the chairs. So merchandise inventory is debited and cost of goods sold is credited. So how much is the actual value of these 5 chairs? Well, remember how each chair, the value is 70? Well, we're getting it back. So we need to calculate how much 5 chairs, what is the value of 5 chairs? So 70 times 5. Since 5 chairs and each cost 70, it's 350. So we're getting $350 worth of merchandise back. Okay, now moving on to October 31, counted the inventory and determined there were 74 chairs on hand. So, how many chairs do we have? In this case, we need to find out how many chairs we have. So, in the beginning of the question, it says there's no office chairs in stock. October 6th, you purchased 100 office chairs. And then you sold 30 chairs. And then October 11th, you gained 5 chairs. And that's it. So 100 minus 30 plus 5. That should be 75. So you should have 75 chairs. But on October 31, it says that there's 74 chairs. So 1 chair just disappeared. So in this case, you want to, again, debit cost of goods sold and credit merchandise inventory. Since you lost 1 chair, and remember 1 chair cost $70, so cost of goods sold 70, and merchandise inventory, you lost $70 worth of office chairs. Okay, now for November 8th, received payment from Butler Inc. for the amount owing. So we need to find the journal entries involving Butler Inc. So we can see how on October 9th, they owed $4,050. And again, on October 11th, we gave them an allowance. So now $4,050 minus $675. That's $3,375. I just skipped November 5th. Okay, let's do November 5th first. Paid Cats Ltd. For the chairs purchased on October 6th. So remember how when you pay on accounts payable is debited, in this case, to Cats Ltd. And then the debit account is cash since we're paying. So how much do we have to pay them? It says it was purchased on October 6th. So $6,800, that's what we owe. So we're going to pay $6,800. Okay, finally, let's do November 8th. Received payment for Butler Inc. for the amount owing. So when you're receiving a payment, cash is going to go up and accounts receivable is going to go down because they no longer owe you the money since they paid it. In this case, it's accounts receivable, Butler Inc. And as I calculated before, all I did was take the $4,050 and subtract the credit that we gave them, which is going to give us $3,375. And that is it for this question. Travel Warehouse distributes suitcases to retail stores and extends credit terms of N30 to all of its customers. Travel Warehouse uses a perpetual inventory system, and at the end of June, its inventory consisted of 40 suitcases purchased at $30 each. During the month of July, the following merchandising transactions occurred. July 1. Purchased 50 suitcases on account for $30 each from trunk manufacturers, FOB destination, terms N30. So this transaction, you're gaining merchandise inventory since you're buying suitcases. So it's a debit to merchandise inventory. And since you're not paying it right away, it says you purchased it on account. The credit account is accounts payable. And in this case, it's to trunk manufacturers. And how much inventory did we buy? Well, we got 50 suitcases, and each of it cost $30. So when you multiply it, you get 1,500. So that's the amount of merchandise that you bought. And it says FOB destination. FOB destination means the buyer pays, and in this case FOB destination means the seller pays. FOB shipping point means the buyer pays. So FOB destination means the seller, and you bought the merchandise, so you are the buyer. So that means you don't have to pay anything. Okay, moving on to the next transaction. Received $150 credit for 5 suitcases, returned to trunk manufacturers because they were the wrong color. So when you are the one who are receiving the credit, well, you don't have to pay them as much. So the debit account is accounts payable. Trunk manufacturers. Because they're lowering the amount of money that you owe them. And the credit account is merchandise inventory, because you returned it to trunk manufacturers, so you're losing that inventory that you bought. And it says that you received $150 credit. So how much money does the money you owe go down by? It goes down by 150. Okay, now July 3rd, sold 35 suitcases on account to Satchel World for $55 each. So you're selling them on account, which means they're not going to pay you right away. So the debit account is accounts receivable. Satchel World. And the credit account is sales, since you're selling the suitcases. So how much do they owe you? They sold 35 suitcases and it cost $55 for each. So if you multiply them together, it's $1,925. And whenever you're selling something, there's two journal entries. One is just recording the sales and accounts receivable, and then the other one is recording the loss of merchandise inventory. So the debit account is cost of goods sold, and the credit account is merchandise inventory, because you're losing that when you sell it. So you sold 35, and now we need to find the value of those suitcases. And we can see in the question that you purchased 40 suitcases at $30 each. And then in July 1, you bought 50 more, but they're also for $30. So each suitcase is worth $30. So if each suitcase is $30 and you sold 35 suitcases, you can do 30 times 35 to find the value of them, which is $1,050. So you lost $1,050 worth of suitcases. July 4th issued a $55 credit memorandum to Satchel World for the return of a damaged suitcase. The suitcase was determined to be no longer saleable and was destroyed. So the first part was that you issued a $55 credit memorandum, and this just means you made them pay $55 less. So the debit account is sales, returns, and allowances. And the credit account is accounts receivable, since you're letting them pay less money. So they owe you less money. And how much less do they owe you? They owe you $55 less. Now usually if it goes into your inventory, then you can debit merchandise inventory and credit cost of goods sold. But in this case, the suitcase was no longer saleable. So if it's no longer saleable, you have to record a loss. So the debit account is going to be loss. This is a special one, so that's why my teacher made it red. Lost on damaged goods. I think loss from damaged goods. And the credit account is going to be cost of goods sold. Because usually it's merchandise inventory, because you're returning it, so you're getting it, and then you credit cost of goods sold. But in this case, it's just going to be loss from damaged goods and then cost of goods sold. So how much is it? It's $55. Wait. In this case, you want to find the real value of it. So it's actually going to be 30, because each suitcase is worth 30 and they returned one suitcase. So loss from damaged good is going to go up by 30, and cost of goods sold goes down by 30. July 18th, purchased 60 suitcases on account for $1,700 from holiday manufacturers. FOB shipping point terms end 30. Again, you're purchasing merchandise inventory. And it's on account. So credit account is accounts payable, because you owe the money. And now it's telling you the total amount that you are supposed to pay. It's not telling you the individual amount. So it told you that you owe them $1,700 in total. And FOB shipping point means the buyer pays and you're the buyer. So in October 18th, the second one, it's telling you that you paid $100 freight to AA trucking company for merchandise purchased from holiday manufacturers. So when you are the buyer and you're paying freight, you're going to be debiting that to merchandise inventory. And credit to cash. Okay, now on July 21, you sold 54 suitcases on account to Fly By Night for $55 each. Again, on account means accounts receivable is going to be debited, this time to Fly By Night, and the credit account is going to be sales. Kind of like revenue. And this time it's saying the amount for each suitcase, which is $55 for $54 suitcases. And if you multiply that together, the total is $2,916. And we're going to have another journal entry talking about the merchandise inventory going down. So debit is cost of goods sold, and then credit, merchandise inventory. Now, we know how in the question it says that $30, each suitcase is worth $30 each, and on July 1st, it says you bought another one for $30 each. But then if you look at July 18, you purchased 60 suitcases on account for $1,700. So if you do 1,700 divided by 60, you're going to get each suitcase costs $28.3. But then if you look at the second 18, it says you paid $100 freight. So this $100 is going to be added to 1,700 to get 1,800. And then that is a total value for 60 suitcases that you purchased. So if you divide 1,800 by 60, you get 30. So in fact, you just bought it for $30 each. So you don't have to panic here, and just you can use $30 for the worth of one suitcase is $30. So if there's 54 suitcases, 54 times 30 is 1,620, which is how much it's worth. Merchandise inventory goes down by 1,620. Now, July 23rd. Gave Fly By Night $220 credit for 4 returned suitcases. The suitcases were in good condition and were restored to inventory. Whenever you're giving a credit or whenever you're giving an allowance, the debit account is sales, returns, and allowances. Credit account is going to be accounts receivable, because you're lowering the amount of money that they owe you. And how much money is getting lowered from the amount? Well, it says in the question 23, gave Fly By Night $220. So that's the amount of money that they're now not going to owe you anymore. In the second part, the suitcases were in good condition and returned to inventory. We can do merchandise inventory, since you're gaining that inventory, and the credit account is just going to be cost of goods sold. And remember how each suitcase, the value is $30, and if you return 4 of them, that's 30 times 4 for the total value, which is 120. Okay, now our final, not yet, but almost final transaction. July 30, paid trunk manufacturers in full. So that means you owed them something. So debit account is accounts payable. Trunk manufacturers. Credit account is cash, since transaction is just saying that you're paying them. Now, how much do you owe them? Let's go back and see. So here, you owe them 1,500. And then the second one, you owe them $150 less, so minus 150. And that's all. So 1,500 minus 150 is 1,350. So that's the amount that you're going to pay them. Now on July 31st, you received the balance owing from Satchel World. So when you're receiving money, debit is cash and credit is accounts receivable. And how much are they going to pay you? Let's take a look. So here, they owe you $1,925, but then you gave them allowance, so they owe you $55 less. That's it. So 1,925 minus 55 is 1,870. So that's the amount of money that they're going to pay you. So that is it for this question.